it's human nature. We see
Yeah.
the S&P 500, we see Tesla, we see all these companies, just NVIDIA going up like crazy. We just want to be part of it. But I think go back and ask yourself, what's the game we're playing and how long are we playing it? Are we trying to achieve our goals over many, many decades? Okay, that's a much different investment strategy than trying to have the best return in 2025.
Welcome to the Military Money Manual podcast, where every episode is all about achieving financial independence in the military faster than before. We believe personal finance shouldn't be boring or intimidating. Building wealth can be simple, and financial freedom is the ultimate financial goal. Now, here's your hosts, Spencer and Jamie.
Erik, welcome back to the show again. Last time we talked about how much cash do military families need to keep around and not invest. And today on the show, we're going to talk about, okay, we've got some cash, we're going to put it to work. We're building our portfolio, we're building our asset allocation, we're coming up with our overall game plan. And one of the first questions people run into is, do military investors need international stocks in their portfolio? What do you think?
Yeah, thanks for having me again. Happy to be here. Yeah, I would say it's probably a good part of a well-diversified portfolio, a global portfolio, certainly. If we look at the US is going to make up about 60 to 70% of the global market, right? It was more like 60 a few years ago. It's trending towards 70 now because S&P 500 has done so well. But so if we're looking at like global growth, if we're not investing internationally, we're kind of throwing away 30 to 40% of the world economy, which to me, if I'm a long-term investor, doesn't seem like a very astute decision. Now that being said, like it has to be part of your belief system. So I would say like the average person I run into with their TSP has maybe like 7%. That's probably the average international. Lots of them have zero. It's just because if we look at the last 14, 15 years, US stocks have so broadly outperformed international that so many folks have, I think, performance chased and kind of just over-indexed on that US outperformance, and the persistence of that outperformance in the decades to come, if you look at history, isn't the smartest bet to be making. So I do think it has to be part of your belief system, though. We cannot just be all US and now, in 2025, all of a sudden US is underperforming international. We're going to go half international. And then when it flips the other, like we can't do that. I think you can have great success investing in the Vanguard Total Stock Market Index your whole life and not even looking at Vanguard once for 70 years. I think you do great. I also think you can do really well with a global portfolio that's going to be internationally diversified. There's a lot of studies out there that would show you probably have better risk-adjusted returns than just a US portfolio. We can certainly look at like the last decade of 2000 to 2009 and how poorly US stocks performed in comparison to international. So I guess all that being said, you need to do the research yourself if you're managing your own investments and know why you need to be diversified internationally or not.
So Erik, are you saying that the U.S. performs when the international is down and international performs better when U.S. is down? So they're offsetting. Is that what you mean by like balancing the risk? They don't both go up generally at the same time as high?
Yeah, so that would be like correlation, right? Things that are like perfectly correlated are going to move in tandem. Things that are negatively correlated are going to move opposite. U.S. and international stocks are not like perfectly correlated, certainly, but they're not negatively correlated. They've become more correlated, I think, over time, but they're still going to move in very different directions. I think year to date, as we're talking, the international Vanguard ETF is up something like 8%, and I want to say or 12%, and the US is down 8%, so it's like a 20% difference or something like that. I just looked the other day, so they're not going to move perfectly, but yeah, that's what I'm talking about. That's that diversification is. We're investing in a globally diversified portfolio. We believe in global growth. I think if you look back in history, sitting today in 2025 and saying the US is going to crush everyone the next 30 years of my investing life, and that's all I believe in, it's kind of crazy because if you said that back in 1900 or 1920 or 30 or 40, that the US was not going to grow because it's like a newer country and Europe's going to be the best, it's kind of crazy when you look back over longer periods of time. I would just encourage most investors to especially those that are listening to this podcast are probably 20s, 30s, 40s. Your investing time horizon is not just to retirement at 65 or whatever. It's probably something like 60 to 70 years of your lifetime. And then those of us that are going to give money probably to the next generation, really some of the equities are it's crazy to think, but it's not crazy to say, 100-year plus that that money is going to be invested for. So I think not taking a look historically back at what happened the last 100 years and only looking at the last 10 to 15 is a little short-sighted.
Yeah, especially, this is one of those things where it really helps to have a historical perspective and to really zoom out and look at kind of macro trends. And I mean, there's that great chart where it kind of shows like the size, relative strength of different empires over thousands of years. And, the US is actually it's very recent compared to a lot of the older empires. I mean, as recently in my lifetime, as recently as 1987, the US as a percentage of the global market, the US stock market's percentage of the global market was 30%. Wow. So it's crazy to think that now we've just accepted that the US market as a share of the global stock market is 60 to 70%. But that even within my lifetime, that wasn't necessarily true. Japan in 1987, Japan was 40% of the global stock market value. Today, it's 5%. So it's just kind of, and that's not zooming out to 100 years. That's just zooming out to less than 40 years. It's really important that when people are, like J.L. Collins makes the argument in The Simple Path to Wealth that, somewhere between 25 and 30% of the total revenue generated by American companies, by the S&P 500, comes from non-U.S. sources. And so he's like, look, you've already got some international exposure because U.S. companies are global companies. So Coca-Cola sells more Cokes in Asia than they do in North America. I don't know if that's true. I just made that up. But so don't quote me on that one. But the point is that, U.S. companies sell overseas and they generate profits overseas. And, that's just to be expected. Like Amazon, Microsoft, all these cloud computing giant tech companies. Apple's an American company. They sell a lot of iPhones in China. Those companies do have international exposure just because of where they operate. But I think as an investor, we don't have to just accept that and say, okay, well, that's my international exposure because U.S. companies operate overseas. Look at some of the oldest and most profitable companies in the world. You look at like Nestle, you look at Toyota, you look at Novo Nordisk from Europe. And if you want to have share ownership, if you want to be a part owner of these companies, the easiest way to do it is just buying a low-cost international index fund. And in fact, in the TSP now, they have a new iFund, which gets you 99% of global market exposure, except for US markets, Chinese markets, and Hong Kong. And there's even 23 emerging market countries represented in the new TSP iFund. So I think for a long time, people have been sleeping on international investments. And it's hard to, if you look back, like you said, in the last 15 years, it's hard to justify why they should be looking at international. But just this year, 2025 has been a great example of they're not moving correlated. In fact, they're moving apart where the international stocks are outperforming the US stocks.
Just to piggyback on that, to give some numbers to it. So as we're talking today, like the DAX, which is their like NASDAQ, if you will, or their S&P 500, it's up 28% year to date. The S&P 500 is down 3 or 4%. So German stocks outperforming US stocks by over 30% in a couple of months is kind of crazy. And it's something that happens fast and is kind of unpredictable. You can't now just go invest in German stocks and expect that outperformance. That's something you would have had to hold beforehand. Just an example. Another example of the lost decade, that's what we keep referring to. 2000 to 2009 was just a relative crazy outperformance of international stocks versus the US. We can link this in the show notes. This is a graphic from Dimensional Fund Advisors detailing the annualized returns from January 2000 to December 2009. S&P 500 was a negative 0.95% per year. Dimensional Fund Advisors has these indexes that track large cap, small cap, whatever. So their large cap index was 4% a year, US. Their small cap index was 7.9% a year. Their international market-wide value index was 7% a year. Their international small cap value index was 13.7% per year. Their emerging markets index was 10.89% per year. So when you talk about how these things can switch in the other direction, kind of shows you like, wow, that was a decade of outperformance for international. And now the US kind of got the upper hand for 15 years.
Hey, Erik, Spencer mentioned the iFund and the TSP. We talk sometimes about life cycle funds, especially for beginners that don't know where to start. Just throw it in, or just keep it in the one you're automatically enrolled in when you start under the blended retirement system. The life cycle fund that most of our listeners will be in has about 30% of international exposure. Is there a set percentage that you'd recommend if someone is listening to this and they like, okay, I believe I need international exposure? Is that about right for a 20 or 30-year-old average investor?
I think that's a fair percentage. I think it goes back to your belief system. If we just start, I like to start with the global portfolio, something like 65% US, 35% international. So how do we want to deviate from that? If we live in the US, or we believe in the US, maybe we want to be 70, 75 US. Awesome. Cool. Let's just stick with that. I'm big on like principles and why we're investing and then sticking with it regardless of, short-term returns. So I think if that investor is going to say, hey, 70-30 sounds great to me. I understand why that would be. I believe in that and I'm going to stick with that. Yeah, I think that's awesome. But yeah, I'd say anywhere from 20 to 40% international isn't crazy in a portfolio and is pretty healthy.
I think a lot of our listeners are going to say, wow, that's really high.
And I would agree, just having obviously seen a lot of folks' portfolios that have come through the door, clients, prospects. If I had to put a broad average on that international mix that someone's going to have on their own, absent being in a life cycle fund, something like 7 to 10%, maybe. Many zeros. Okay. Many people in all US, CNS fund, just VTSAX, whatever it may be, total stock market. Just because that last 5, 10, 15 years has been so strong in the US, it's human nature. I've actually had clients come through the door. We allocate their portfolio nicely. Their 401k that I don't manage directly. We'll log in together, screen share, we'll pick the allocation. And it's funny, a year or two later, when we check in on that allocation, they'll since have gone in and put it all to US because of the outperformance. And I'm like, no, that's exactly not what we're trying to do. So we'll slap them on the hand, we'll get it back. But it's human nature. We see the S&P 500, we see Tesla, we see all these companies, just NVIDIA going up like crazy. We just want to be part of it. But I think go back and ask yourself, what's the game we're playing and how long are we playing it? Are we trying to achieve our goals over many, many decades? Okay, that's a much different investment strategy than trying to have the best return in 2025.
I think it's important to acknowledge too that when your job is in the US, your home is in the US, your family is in the US, and then all your investments are in the US, yes, the United States, it's a big basket, but it is still just one basket and you have all your eggs in there. And as a prudent investor who, again, takes a historical perspective, maybe it's okay that over the last 15 years, your returns were 2 or 3% less per year because you had some international exposure. But that was the cost of hedging. That was the cost of ensuring that if there was to be some catastrophe in the United States, or if we were to have a lost decade again, or, if you look at 2000, 2001, 2002, we had 3 consecutive years of negative double-digit losses in the U.S. stock market, and that could happen again. And historically, when that happens, there are recessions, and people lose their jobs, and people, foreclose on their home, and so all of a sudden, you've decided that, okay, yes, you trust this basket, and you've got all your eggs in that basket, but why not just diversify a little bit outside of your basket? And, sometimes it's hard for Americans because we don't travel very much. We don't see a lot of the rest of the world. We don't understand what's going on over there. But go to Tokyo, go to Japan, go to Korea, go to Seoul, go to China and look at what they're doing. They are working hard. There are companies that are building massive skyscrapers and, generating huge profits. Many of the things that you use every day, especially in technology, they're manufacturing it. We're not manufacturing it in the States. And to say that you don't want to have any part of that and you don't want to be investing in Taiwan Semiconductor or into the big chip foundries that are in Europe, that we literally don't have that in the United States. And, we're working on it. We're trying to, IBM and Intel are trying to bring some of that manufacturing home. But as it stands right now, we just, if there is going to be, a giant AI revolution in the next couple of years and you want to own the robots, well, unfortunately, we're not making most of the robots in the US right now. So I think it would behoove the wise investor to just acknowledge that maybe while the US is the greatest country of all time, and, I'll say that hand on heart, it's okay to diversify your risk just a little bit and to invest in some great companies around the globe.
I'll add to just some perspective, it's home country bias is kind of the bias we're talking about for US investors not investing internationally. It persists though across the globe. I've got a graphic pulled up here that I found on Google. They did a study saying in some different countries, how much of global market or how much of the domestic equities do they hold, right? So in the United States, this thing said 80% So US investors hold 80% of their portfolio in the US, even though at the time of this graphic, the global weight of the US was like 51%. Canada was 59% Canada holdings. They make up 3.4% of the global market, right? Australia, 66.5% Australian holdings. They make up 2.4% of the global market, right? So you can see this home country bias persists across the globe. It's natural. We want to invest in companies that we know we buy goods from every day. We see them at the grocery store. We do need to set our sights on what's going on in a bigger global market if we do want to truly be investing for global growth in ways that have made sense, over hundreds of years.
Living here in New Zealand, which makes up 0.2%, 20 basis points of the global stock market. And the standard advice for most retirement accounts here is to have 35% of your assets invested in New Zealand shares market, which the New Zealand share market is worth about 180 billion US dollars, which is the market cap of Starbucks, the 92nd largest US company. So home country bias. It's not just the US. It's not just in the US. And it's difficult actually to have conversations with people and talk to them about investing in the global market because people, like you said, they like to invest at home. They know these companies. They might know people that work there. They might buy their goods and services every day. And again, our brains are still hunter-gatherer brains, right? Like we haven't evolved past the savannah in the last 200,000 years. So to tell someone that, hey, there's this tribe over there that you've never met and they're making some great pottery and you should invest in their pottery. I mean, our brains are just they're not designed to do that, right? Like, no, I want to invest in my local pottery production. But I'm telling you, this Egyptian pottery over here is top notch, and they're building these pointy triangle things too, and you're gonna love it. They're gonna stand for 1,000 years, and you're like, nah, it sounds like a pyramid scheme to me.
Yeah, I get it. I see what you did.
Just a quick note from one of our sponsors, and then we'll be right back to the show.
It's no secret Spencer and I are both huge fans of the Thrift Saving Plan, the military's version of the 401k retirement plan. We've both been investing in the TSP for over 14 years and are thrilled to announce we've consolidated all the information you need to know into a new course called the Confident TSP Investing Course.
That's right. The course is a comprehensive guide to navigating the TSP, breaking it down to easy, bite-sized chunks that lay out the basics of the thrift savings plan, the funds available, and the investing strategies so you can build wealth while you serve.
We both know what it's like to be a beginner and to be overwhelmed with all the information that's out there about investing in the TSP. Head over to militarymoneymanual.com/TSP, Tango Sierra Papa, to find our simple breakdown of all you need to know. You get lifetime access, and we'll have a growing library of content. And one of my favorite parts about the course is that for every course we sell, we're going to be donating one to an E4 or below.
Yeah, I love that feature of the course, Jamie. So if you're an officer, an NCO, a senior NCO out there, and you purchase a course, first of all, thank you. And also know that you're helping a fellow service member, a sailor, a soldier, a Marine, an airman, a guardian, a Coast Guardsman, E4 or below, take one step closer to their financial success.
The link's in the show notes, or head over to militarymoneymanual.com/TSP, where you can sign up for the Confident TSP Investing Course. Now, back to the show. Okay, let's say that you've convinced the listener, I had zero international exposure and I know I need to do something now. What do I do? Do I just go in and switch my iFund? I go back to life cycle? Do I have to go to Vanguard, Fidelity, Schwab?
Yeah, it just depends on what's that mix of investments you've got. Do you have is the TSP most of your investable net worth? Well, then the iFund's going to be your main option. If we've got a sizable Roth IRA, taxable brokerage account, stuff going on over in Vanguard, we're going to have other options for international. So it also depends on, are you going to invest the same in each account? And when I say that, are you going to have let's say your mix is 70 US, 30 international? Are you going to invest 70-30 in the TSP, 70-30 in your Roth IRA, and 70-30 in your taxable brokerage account? Or are you going to get a little bit broader view and look at it holistically and say, hey, I want to hold the 70-30 across the board? Where's the best spot to hold an international investment or emerging markets? Is that the iFund? Maybe not, because it doesn't have China and it doesn't have that much emerging markets. Maybe I want to hold that in Vanguard. So that's kind of where you can get a little bit more nuanced in your approach. But I'd say most folks grabbing that iFund, if that's TSP is going to make up a lot of most listeners, most of their investable assets, grabbing that's a good start.
I've seen when we've talked about doing MilTax, H&R Block, the free software for tax returns in Military OneSource, there's a question that comes up when you have the 1099 about international taxes paid. Is it going to be more complicated or anything that makes my tax situation miserable by having international exposure?
Usually not. It's going to be nominal. Again, unless we're talking millions of dollars held internationally, that's going to, have some foreign income tax credit or something. It's not really a concern for most folks. It's going to be probably a rounding error.
Thankfully, with the, Schwab, Fidelity, Vanguard, BlackRock, all the big investment houses taking care of these ETFs and these mutual funds for us. I mean, it's the 1099 just simplifies everything. And so at the end of the day, you're just a monkey punching in numbers, and if there's a foreign taxes paid thing there, it's going to be handled for you in your tax software. And if you're getting to the point where that number is getting really big and you're getting kind of nervous about, how it's all interacting and stuff, you have a CPA. Go hire a CPA. We've got the Military Tax Experts Alliance, militarytaxexperts.org. You can talk to any of the people on there who usually veterans, military spouses, fellow active duty troops, and they understand your W-2 coming from the Department of Defense. They understand what tax-free pay is, and you can log on there. And if you got any questions, just shoot them to them. And if it's getting too complicated for you, you just want a second set of eyes to do your taxes for you. A lot of their prices on there are very reasonable. And one thing I always recommend to people too, if taxes are starting to become like a source of anxiety, which it can for a lot of people very quickly, hire a CPA for 1 year. Just have them do your taxes for 1 year, because for most people, their tax situation isn't changing that much year to year, unless you have like a significant, lifetime event, like you're getting married, you're getting divorced, you're having a kid. But in general, most people's tax situation is not changing too much, especially if you're on active duty and you were on active duty last year, you're on active duty this year, maybe you had a PCS in there. But it could be really good to have a CPA. Just do your taxes for 1 year. You pay a little bit out of pocket. Maybe they find a deduction that you didn't know you qualified for, and all of a sudden they just paid for themselves, or you've made money on the transaction. And then if you didn't enjoy the experience, or you thought I was doing it right the whole time, then just go back to DIYing it yourself the next year. Maybe you spend a couple $100 out of pocket to have someone double check you. But I think it just gives you that confidence that either A, you were doing it right, or B, now you know you were doing it wrong and you can do it right going forward in the future. Especially with those like military spouse residency questions. I see it all the time online where people are they're wrapped around the axle because they're remote working here, their state of legal residence is there, their spouse is from here, and it's becoming a nightmare. And if you can have a CPA, figure it all out for you, file the paperwork for you, and then a lot of times they've been incorrectly paying state income tax to a state where, they've been married for enough time that they could have claimed the spouse's state of legal residence, and the CPA can go ahead and file tax returns for the previous 3 years and then get those state income taxes back for you. And that could be a multi-$1,000 payday of money that you are legally owed. So that's a great way to use a CPA.
Erik, this might sound a little silly, but I'm sure I'm not the only person that's heard someone say this. And I even remember when like Mitt Romney was running for president, there was like a news article about him having foreign investments. Like, am I, as a military member with a security clearance, is it bad for me to have foreign investments? Like, am I actually okay to invest in Chinese markets in Vanguard accounts?
Don't quote me here, but I've generally seen absolutely no issues ever having an ETF or index fund of any kind, not with security clearances. Like, I've never seen any issues, and I've had clients that have said, hey, when they've come on board, like, hey, I've got this job, so I can't invest in certain companies. And those index funds have never posed any issues. I can't speak to like if you're selecting individual Chinese companies to invest in and you've got like some secret green door job, maybe that's a little bit different. But the ETFs are generally safe. I've never heard of those posing a problem. Again, don't quote me. There could be a certain job where you can't invest at all. Who knows? But given all the holdings that I've seen congressmen and women hold, I think we'll be okay with index funds. That's for sure.
Fair point. Okay, so great reminders for military families about international exposure. Remember to evaluate what you have. The best way to do it is pull up your accounts. Take a look at what international ETFs you have, or maybe your TSP, what's in the iFund. You can check that out on your TSP account, and you can change that on your MyPay account if you are open to some international exposure. We talked through today with Erik Baskin some percentages, some things to consider for the iFund versus other ETFs with your brokerage account. The big thing is just understand what you believe in for your investing philosophy and why. Erik, one last comment or anything we didn't get to yet that the listeners need to understand about international exposure? Thanks so much for coming today. What do you think?
I don't think anything else. I think you summed it up well. Do your research. If you're managing your own investments, know why you hold what you hold in your portfolio. Be convicted in that and hold it for really long periods of time. That's as simple as that. So thanks guys so much for having me. Always fun being on the show.
Thanks so much for tuning in to this episode of the Military Money Manual podcast. If you're enjoying the show, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. This helps others find the show, and we really appreciate it. Thanks again for tuning in, and we'll catch you in the next episode.
The views and opinions presented here are those of the speakers and do not necessarily represent the views of the DoD or its components. Reference to any commercial products or services does not constitute DoD endorsement of those products or services.